Why are economic indicators important for understanding inflation trends? In today's fast-paced economy, understanding inflation trends is more important than ever. Just yesterday, inflation data was released, prompting many to question how it will affect their daily lives. With rising prices on essential goods and services, viewers are searching for clarity on what economic indicators reveal about these trends. Economic indicators are essential tools for tracking and interpreting inflation trends. They provide measurable data about the overall health and direction of the economy. Inflation itself reflects the rate at which prices for goods and services increase over time. This directly impacts purchasing power and economic stability. One key economic indicator is the Consumer Price Index. This measures the change in prices of a basket of consumer goods and services over time. It is often expressed as a month-on-month or year-on-year percentage change. The Consumer Price Index is widely used to gauge the inflation rate experienced by consumers. Another important measure is core inflation. This excludes volatile items like food and fuel. Central banks focus on core inflation to assess underlying price pressures and set monetary policy targets. They usually aim for around 2%. The Producer Price Index and personal consumption expenditures also track price changes at different stages of production and consumption. These provide additional perspectives on inflation dynamics. Gross domestic product is another indicator to consider. While it measures the total value of goods and services produced, its growth rate influences inflation. Rapid economic growth can lead to higher demand and upward pressure on prices. Conversely, slow growth may ease inflation. The unemployment rate is a labor market statistic that indirectly affects inflation. Lower unemployment can increase wages and consumer spending, potentially driving prices up. It is a lagging indicator but helps contextualize inflation trends. By monitoring these indicators, economists, policymakers, and investors can anticipate inflationary pressures or easing. For example, rising tariffs on imports can increase costs and push inflation higher. Recent United States tariff policies have suggested a potential inflation increase of up to 1.5 percentage points annually. Inflation expectations, measured through surveys like those by the Federal Reserve Bank of New York, also matter. They reflected how consumers and businesses anticipate future price changes. Stable long-term inflation expectations help central banks maintain confidence in their inflation targets. In summary, economic indicators provide a factual basis to understand current inflation trends and forecast future movements. They guide monetary and fiscal policy to maintain price stability and economic growth. Without these indicators, interpreting inflation signals accurately would be challenging.